Thank you for joining and a warm welcome to PayTM's earnings call to discuss its financial results for the quarter and half year ended September 30th, 2022. From PayTM's management team, we are today joined by Mr. Vijay Shekhar Sharma, founder and CEO, Mr. Madhur Deora, president and group CFO, Mr. Bhavesh Gupta, CEO lending and head of payments, and Mr. Anuj Mittal, vice president investor relations. Before we start, a few standard announcements. This earnings call is meant for existing shareholders of PayTM, for potential investors and research analysts to discuss the company's financial results. This call is not for media personnel. If any media representatives are attending this call, request you to kindly drop off the call at this point. The information to be presented and discussed on this call should not be recorded, reproduced, or distributed in any manner. Some statements made on this earnings call may include forward-looking statements. Actual events may differ materially from those anticipated in such forward-looking statements. Finally, this earnings call is scheduled for 75 minutes. It will have a presentation by the management followed by Q&A. Kindly utilize the raise hand feature of your Zoom dashboard if you seek to ask a question. We will unmute your line in the respective sequence and within the scheduled and permitted time. Please ensure your name is visible as first name, last name, followed by a company name at all times for us to identify you. The presentation, a replay of this earnings call, and a transcript will be made available online subsequently. With this, I would like to request Mr. Vijay Shekhar Sharma to kindly initiate this earnings call.
Thank you, and hello everyone. Good evening, good morning. I'm very happy to welcome you all for our earnings presentation for our quarter ending September 2022. As you may have seen, we've had a good quarter as teams have performed very well on the focusing on our commitment to target break even by second quarter next year before ESOP cost. As you know, I will give you a little bit of summary of the business model once again, that we acquire customers and we had 80 million transacting customers, and these customers in turn bring us merchants, and we have 30 million merchants who in turn work and give commerce services to consumers. This makes our business model core business to acquire customers on payments, and in turn, because this gives us insight, ability to distribute, and a great brand name, we work with our lenders to distribute credit. So as you may be aware, over the period of time in last 4 quarters, we have trimmed since IPO tremendous amount of businesses and focused on key business areas and pruned many business line items and made it very clean and clear that we acquire customers for payments and distribute loans from our credit partners. In fact, our payment business, which is based on our merchant side business model, where we deploy QR codes for merchants to enabling them for Soundbox or giving them for various devices and enterprise payments, we have expanded into online and omni-channel merchant, which is an approach that the market is taking shape towards. I believe the payment will become more and more omni-channel, where companies are going to be, online companies are going to be significantly offline, and offline companies are going to be online. Case in point, Flipkart, with whom we work, has lots of online business. We also help them take offline payments because there is a lot of cash on delivery out there. So this is something we keep an attention to. And then merchants use our platform, which we call consumer payments, to collect payments. So technically, online merchants use our app to collect payments. If you notice, our payment business, which is core payment business, thanks to a model where we have added subscription and UPI MDR, which we don't account for yet in our business model till the time government gives. So subscription and MDR revenues mostly, and a little bit of platform fee. So these revenues right now that you are seeing on the right side are inclusive of MDR, subscription, and select customers platform fee only. The government's giving of UPI subvention revenue is going to be given only in the quarter that we get that money. So these are the revenue line items that we ended up making absolutely for payment, and enabling commerce and cloud service also grew very healthily year on year. And as you can see, this is a business that is 55% up year on year, 1,550 crores. We believe the payment stack is this stack where we help merchant take payments in different avatars, locations, occasions, and opportunities, and enabling them for commerce. This stack makes for a scalable large, growing profit and profitable business model for payment and enabling cloud commerce business. Credit business, as you are aware, is based on the foundation that our abilities of digital lending sourcing and cross-selling partnership with our lending partners, and over the period helping them collect the loans, make this business model. I call it typically in a fund management that this is a part where we get fixed fee. This is a part we get sort of a portfolio performance or carry, if you will. So you can imagine that this business model has an inherent compounding, because when we disperse the loan, we get certain percentage, but our ability of collecting, our ability of effort of collections enable us to get sort of a portfolio performance bonus on that. Important thing to note is that in last quarter, RBI came out with clarification around digital lending, sourcing, and EMI servicing collection opportunity. PayTM's business model was completely looked as clearly following the suggested guidelines. So we are very happy to tell you that we have been able to include every delta incremental, whether small or large, in the business model, and business model was very, very much aligned to how regulators sees it. We continue to believe that this loan disbursement and collection business for India will play an important role in democratizing credit. If you remember, at one point in time, RBI leveraged public sector banks, then created private sector banks, then created NBFCs, and now we believe different buckets of credit requirements were satisfied with that. And today, the digital lending service provider, as LSP RBI calls them, which is what PayTM is here, will generate and create new opportunities for dispersing digital credit. As you are aware, our digital disbursement are typically small ticket loans, and we internally call these two businesses as 2 lakh rupee and 2 year, 10-year kind of loans, where average answers are 1 lakh plus one year and 150,000 plus 1 year. And this is what the typical ticket size anyways remains in personal loan, merchant loans. And PayTM Postpaid, which is where customers get an overdraft limit from lender to spend, it is typically now averaging around 4,500. The good part, in my opinion, is that while these are incredible year-on-year growth, they are very small fraction of our customer base, which is in availing all three services for us. And there is an incredible amount of headroom for our disbursement opportunity quarter on quarter, and we continue to see post reclarification and reconfirmation from RBI that this business model and this workflow is how regulator expects. It has now opened doors for many more lenders and many more partners to continue to join us and expand this business. I would now call upon my colleague Madhur to expand and give you a summary of overall business and the numbers. Madhur.
Thanks, Vijay. Welcome everyone to our earnings call. I'm very proud to report that we had a very strong quarter. Our revenue growth, as you would have seen from our earnings release, was 76% year on year, and our EBITDA before ESOP cost improved by 61% year on year. Just to get into that, revenue from operations was 1,914 crores, so just under $1 billion run rate. Our contribution profit continues to improve. It's at 44% of revenue. A year ago, this number was at 24% of revenue. So significant step change over the last 12 months. And even on a quarter-on-quarter basis, we have had a slight improvement. And we're currently doing 843 crores of contribution profit. Our EBITDA before ESOP cost is really starting to see operating leverage come through. So 166 crores of revenue, less than 10% of revenue as a loss. And it is nearly a 260 crore improvement from a year ago and over 100 crore improvement from last quarter. So by all measures, significant improvement in EBITDA performance. And we expect, and for the last 2 quarters in a row. Operating highlights, which you already talked about, value of loans dispersed, 7,300 crores, up nearly 6 times. And even on a quarter-on-quarter basis, continues to grow at a very fast clip. And merchant subscription, which is our payment devices, primarily the 4.8 million devices, 3.5 million added in the last 12 months, and obviously faster right now. There's a breakup of revenue. Basically, the basic point of this page is that we have seen platform expansion and increased monetization across businesses. So this is not one or two businesses carrying the overall performance. Our payment services business is up 56% year on year and up nearly 10% quarter on quarter. Financial services obviously growing a lot faster, driven by lending, and commerce and cloud grew 55% year on year and 14% Q on Q. Some of you may have noticed that there's a small amount of other operating revenue here. This has to do with basically a fund that RBI has, which promotes acquiring side for digital payment infrastructure. And we are one of the beneficiaries of that. So it is payments revenue, but our auditors ask us to put that as other operating revenue rather than as payment services revenue. So that's where it is. Our contribution profit, like I said, a year ago was 24% of revenue. Now it's at 44% of revenue. So both in absolute terms and even as percentage terms, significant increase. The two main reasons for this: payments for us is now more profitable. You would have seen that our net payments margin has grown to 443 crores per quarter. Significant improvement in that, and we'll talk about that a little bit later. And clearly, there is a benefit from high margin loan distribution, giving us better mix. On the right-hand side, we're very proud of the fact that we continue to invest in our business in three main areas: technology, sales, and marketing. So, for example, a year ago, we had 94 crores of investments in our sales team or spend in our sales team every quarter. That number is now 172 crores. So despite increasing the investment, which we believe is important for long-term scale and growth for PayTM, we are able to show operating leverage and go from 63% indirect costs is 63% of revenue down to 53% of revenue. So significant improvement due to operating leverage. All of this translates into strong EBITDA performance. EBITDA, like I said, has gone down by EBITDA losses have gone down by 260 crores a quarter due to huge operating leverage. And our EBITDA margin has improved from negative 39% to negative 9%. So 30% margin swing in a single year due to focused execution. And as you may have figured out by now, 20% of that was from contribution margin improvement and 10% of that was from reduction in indirect expenses. Just to get into the payments business a little bit, again, payments, we, as you know, disclose that payment services to consumer and payment services to merchant. The growth of both these businesses was roughly the same, 55% year on year for consumer business. That is basically due to our growth of MTU and GMV. And on the merchant side, 56% growth, which should do 624 crores. And the reason there was subscription and MDR revenue from offline merchants. We did see just meaningful growth in revenue from online merchants this quarter as well, primarily because of some early festive in e-commerce. So some of the big sales that happened in September and so on. As Vijay pointed out earlier, we don't have UPI incentive recorded this quarter, consistent with our methodology. Last quarter, we only record UPI incentives when it is confirmed by MeitY. Net payment margin is up 5x year on year to 443 crores. And in addition to the revenue momentum, which is the main reason for it, we continue to focus on reduction in payment processing charges. And that's why we get this significant uptick. Some key operating metrics for payments. Our MTU is up 39% year on year. So strong performance there continues. That is driven by sort of increasing customer acquisition at relatively benign CACs, but also an improvement in customer retention. Our GMV was up 63% year on year. Like we mentioned in the last quarter, our primary focus in our payments business is to have profitable revenue rather than GMV as a metric. So there's enough and more GMV that one can go out and get. The key thing is can you make revenue and can you make net payment margin off of it? So that's what we optimize for. And as we had mentioned in the last quarter, we got rid of some business that we did not feel either generated as revenue or net payment margin or have significant upsell opportunities. Despite that, we're up 63% year on year. We'll continue to trim business that we don't make net payment margin on, but we will continue to try to make our payments business more and more profitable. Merchant subscription, we have talked about that we are now at 3.5 million. With that, I'll hand over to Bhavesh to take us to the next few slides, please.
Yeah, thank you, Madhur. Hi, good evening, everyone. Good morning.
Our lending business continues to show good results. As you can see that we ended our revenue from financial services, the predominant part of the financial service revenue is coming from lending, while our equity broking business and insurance business also started to contribute. We had 4x growth from 89 crores last year, same time. We ended at 349 crores. And the important part here is that our entire focus continues to be on a lending business, aligning to the new digital lending guidelines. We were always aligned, as Vijay said in his opening statement. We had to make some adjustments that we made to be absolutely aligned to those pieces. And we are happy to inform that there was no disruption in the business. Our business continued to perform exactly for every single day in the same manner. And our BNPL business, personal loan business, and merchant loan business continues to demonstrate the strength of the opportunity that we're leveraging through the PayTM platform. Next slide, please. Yeah, coming to the numbers here, postpaid personal loans and merchant loans. The good information about here in this business here is that all the three businesses are now showing tremendous growth. We are seeing postpaid, which is moved up 5x. We disbursed actually 4,000 crores. And if you look at the September run rate basis, this business obviously looking at a very healthy growth click. It continues to demonstrate great penetration to merchants. And I'm very happy to inform that we have now added 15 million merchants who accept PayTM postpaid between offline and online. This is arguably the largest acceptance of any credit instrument across any funding sources in the industry. And we do see a very large amount of merchants, both online and offline, coming towards getting to this 15 million addition. And we hope to see this number continue towards the trajectory of 20 million and beyond in the next couple of quarters. On the fact that postpaid is just still 4% of our MTU, that's the headroom that we see. And we do see new acquisition continuously happening in a manner that we were seeing, let's say, 2 quarters back. So there is no letdown of new customers getting onboarded on PayTM postpaid, and hence it gives us tremendous confidence that this growth of PayTM postpaid will be as robust as we've seen in the previous quarters. Coming to personal loans, I think personal loan has been growing very, very nicely on a small base. But if I look at June 22 and September 22, from there also, it has almost doubled its business. There are 2 reasons behind this massive growth of personal loans. One, as the PayTM postpaid business is maturing, we are finding that our lenders are getting very comfortable seeing the mature book of the PayTM postpaid business and offering them personal loans. So almost half of our personal loans are being disbursed to customers who have a running PayTM postpaid loan with one of our lending partners. So the journey and the entire customer appreciation of the product is extremely simple. And that's giving us a good growth trajectory. And that is continuing because PayTM postpaid is continuing. We will continue to see PL also continue on the back of PayTM postpaid. The remaining 50% is the customers who are directly coming and applying for PL on our platform. And we also see that trend actually being a nice trend because these are consumers who are looking for a bit higher ticket size amount and they're seeking for something which is instant. And as you understand that 24/7, 365 days is the positioning of for PayTM PL, and that is giving us a good headroom and head start. We again don't see any issue with the TAM. It is hardly less than 1% of our MTU as personal loans, and there is fairly decent amount of headroom ahead for us. While we are now almost averaging 900 crores plus per month on PL, and we're clearly seeing good traction moving ahead for ourselves. Merchant loan, there was a bit of a concern 2 quarters back when we were in COVID. How would merchant loan grow, etc.? I think that's behind us now. The quarter behind June saw the first focus from our perspective, a lender's perspective, in getting the risk capital back on merchant loan. And this quarter was absolutely bang on. We saw great momentum, great acceptance from merchants in seeking merchant credit on the back of great device growth that we've seen, almost 1 million devices a quarter. This number is actually getting good traction, and I can very clearly see that in coming quarters, merchant loan will continue to see great momentum on the back of our devices story. So all in all, overall disbursement business and even the collection performance that we'll talk about in the further slides has been showing great momentum, and we don't see this momentum getting slowed down. We do see calibration happening by our lending partners, which is more initiated by ourselves because we do understand
that quality of portfolio for lending partners is a more important obligation than just scaling the business. As a result of that, every month by design, we work with our partners to take out the last cohort, 5% cohort in our businesses, and make sure that that cohort is not getting renewals for the next month, so that the portfolio quality is maintained the way it should be maintained. So all in all, a good story for us on the lending side. This is the portfolio slide. This is purely an indicative slide, as we always mention, from a lending perspective for accumulation of all lending partners. As we are the collection outsource partners for our lenders, this is an indication. There has been no change that we've seen over the last 2 quarters in this business. The bounce rates, the recovery rates in bucket 1, the resolution rates on gross credit losses, and the expected credit loss continues to be the way the lenders are expecting. I can also confirm, while the ECL numbers called out are the numbers that we've written, the actual credit loss performance is better than these numbers. But we continue to maintain a conservative stand, and so do our lending partners, in making sure that they are providing enough for the credit losses, looking at the macro headwinds or otherwise, and hence the risk appetite and the risk portfolio is being built on this piece. So even on the portfolio, we're seeing very good signals, and we're not so far seen any kind of macro headwinds impacting the portfolio, and that is giving the strength to our lending partners and new lenders to come on board and expand this entire business portfolio with PayTM.
Thank you, Bhavish. Just the last couple of slides, we wanted to cover commerce and cloud revenue. Our commerce business is up about 50% year on year. Travel merchants continue to do well. Our entertainment merchants typically have a seasonally weak quarter in Q2, both on movies and events side. So that had some impact on our quarter-on-quarter performance. Cloud business, on the other hand, continues to do very well, 58% improvement year on year to 252 crores. We have started to see some early signs of recovery in advertising revenue. We did mention in the last quarter that there was a meaningful amount of pullback. So just towards the end of Q2, we started to see some recovery, but obviously it's too early to tell whether that will continue for the next several quarters. On the other hand, we do see growth in our credit card distribution, as well as on our cloud revenue. So those businesses do well. And finally, we just wanted to summarize and leave this with you, which is our improvement in EBITDA before ESOP's costs is continuing, while continuing investments in scale and growth. So what we focus on is 3 main levers. One is platform expansion, so that we have high monetization capacity down the road. Our monetization engine's working, which is revenue growth across all businesses. And finally, on profitability, improving our unit economics while generating operating leverage as we continue to invest in our business. And that is giving us improvement in EBITDA before ESOP costs. So that's all I had. And I'll hand it back to the moderator who can help us with Q&A.
Thank you, Madhu. We will now proceed to Q&A. A reminder to utilize the raise hand feature on your Zoom dashboard if you seek to ask a question. We will unmute your line in the respective sequence. A request to everyone to please have their company name next to their names. We do have a few common names that will help us identify the right person. We'll just give a minute for the queue to settle in. We'll take the first question from Mr. Vidit Jain from Citi.
Hi. Thanks, Anuj. I have a couple of questions. One, on the personal loan side, QOQ, has the growth come from outside of the postpaid base of customers? I asked that because I recall last quarter, the share of postpaid customers was 50%. This quarter is 40%. So I'm just wondering if there's a greater growth from outside that base. That's one. And I'll just come back with the next question.
Sure. Thank you, Vidit, for the question. So your observation is right. Actually, it is on number of loans because we have grown much, much larger than the previous quarter. Percentage were looks that 40% has come from postpaid, but there is nothing material which has changed. One, definitely a material change which has happened as the personal loan book has started to mature more. And I mentioned about this last quarter also. Earlier, broadly, we were doing about 10% approximately to existing personal loan customers when they close their loan, a new loan by the lenders. That percentage is now started to inch more closer to 15, 17%. So that has been, and that ticket size is a bit larger. So hence the value of loans coming from existing personal loan customers has increased, but the postpaid number of loan penetration to overall PL has remained the same. So it's more mathematical outcome, but no material change in terms of the customer adoption of the product.
Got it. Thanks, Bhavesh. My next question is in terms of overall lending partners. Is that number at 8 right now? Same as last quarter, and could you share what percentage of loans disbursed is disbursed by the partner with the highest share among those 8?
Yeah, so the number is actually 9. We've got 3 card partners and we got I think about 5 or 6 lending partners. We don't actually disclose the share that we do, but I can definitely mention to you that we have partners across this category who do personal loan, postpaid, and merchant credit. So there is not one partner who's taking the lion's share of this business. There is a material distribution basis, the lender's appetite on how much business they want to take. But currently, it is reasonably well distributed amongst the partners that we have. And to your other question, we had announced publicly that we've added one more lender, which is Piramal Enterprises. Hopefully, we will take them live sometime in Q4. And we have a decent pipeline of new lending partners that intend to get onboarded to leverage the PayTM ecosystem and the platform for credit. And we obviously welcome all those new partners coming on board, and we will be adding them in due course of time.
Great. Thank you, Bhavesh. Those are my questions. I'll jump back into the queue.
Thank you, Vijit. The next question we'll take from is Mr. Saurabh Kumar from JP Morgan. Sorry, the line is unmuted. Sorry, the line is unmuted. Yeah.
Hi, am I audible?
Yeah, you are.
Okay, just 3 questions from my side. One is, the indirect cost reduction which we've had, or at least the cost control we have. How should we think about the indirect cost growth from here on? The second is, if we look at the EBITDA trend, it's very clear that you could turn positive or EBITDA neutral at least maybe by March quarter. So will that be a fair assumption to be making? And lastly, on the credit card business, could you just comment on what's the card sourcing velocity at this point of time, and how should we think about it? Thank you.
Thanks, Saurabh. Maybe I'll take the first 2 and Bhavesh could take the third question. So on our indirect expenses and EBITDA, maybe I'll take it together. So we obviously have given EBITDA guidance for break-even, which is September 2023 quarter. Compared to the time when we gave that guidance, we are ahead of our plans, but we would like to maintain our September 2023 guidance for EBITDA break-even. On indirect expenses in particular, obviously our focus is to make sure we reduce our EBITDA losses as per the guidance that we have given. But when we do see opportunities, and we do see many opportunities to invest in our business for short and medium-term growth, we do take those opportunities. While our last quarter number was relatively flat on indirect expenses, you would have seen that on a year-on-year basis, we've actually increased our indirect expenses by 47%. So we do continue to make investments in our business. And we have the sort of luxury of being able to do that because our revenue and contribution margin are performing really, really well. So we can achieve both objectives of reducing our EBITDA burn while continuing to invest in indirect expenses where we see high ROI. Bhavesh, you want to take the question?
Yeah, sure. Yeah. Hi, Saurabh. So, Saurabh, on the cards business, we are very excited in building a cards business. It's a very nascent business that we started about 18 months back. We're very privileged to have 2 of India's largest issuers as our partners, HDFC Bank and SBI Cards. And hence, our portfolio of cards business has shown robust growth. While we've not declared actual numbers, but I can only suggest to you is at this point in time, that business is operating much beyond our expectation in terms of customer adoption, coming on the back of the fact that the customer value proposition which is powered by our issuing partners and obviously powered by PayTM platform usage, is really getting us good customer quality, which our issuers are very happy with, and we are seeing very high scale of the card business. What we believe is that our aspiration to build at least 1 million cards a year on issuing side, maybe over the next 12 to 18 months, continues to remain as strong as ever. And we would be guided by that as we build this cards business. And hopefully in the future, as we feel that it is now a material side of our business, we would like to disclose more details about it.
So thank you. So just 1 million cards in 12 months is that the target, right?
No, I'm saying we continue to aspire to build 1 million cards origination over the next 12 to 18 months. And that's our aspiration that we would like to actually meet.
Okay, got it. Thank you.
Thanks, Saurabh. The next question we'll take from is Mr. Kunal Shah from ICICI. Kunal, you can unmute your line.
Hello. Yeah, am I audible?
Yeah, Kunal, you're good.
Yeah. So firstly, again, to touch upon this question with respect to the postpaid, in fact, when we look at the overall traction in terms of the number of loans disbursed, in fact, normally it used to be in the run rate of say 2 odd million, but this quarter it seems to be slightly on a lower side. So just want to get that sense in terms of on the postpaid, why it's just like 0.6 odd million and how should we look at it? Because it's hardly like 7-8% kind of a sequential growth.
Yeah, so Kunal, we had to make some adjustments with regards to new digital lending guidelines, which we had called out very clearly, which meant that our lending partners and ourselves, we had to make adjustment in terms of fund flow. That clarification took time from the regulator. I think it came in about 40-50 days later on, that the entire fund flow has to be reorganized in this manner, which was the way we were doing. And hence that is a disruption that we saw in the last quarter, but it is from a new customer origination and acquisition perspective, we continue to see very robust growth. Every month we're onboarding more than 400,000 new postpaid customers. So that hasn't stopped. It was just a recalibration that we had called out in a specific call that we had done, that we need to align to the fund flow, which took some time for us to align and clarification, which is now behind us.
Okay, so when we look at it now, incrementally, the run rate should get back towards that number. So this was just a quarter's disruption, and that's more or less corrected.
Yeah, so very honestly, we don't track this on that basis that how much is postpaid doing in terms of number of new incremental loans. We track on basis of new customer acquisition. I can definitely confirm to you that our new customer acquisition on postpaid will be highest ever that we've seen thus far, and will continue to have the same trajectory. What will that mean in terms of new customers converting their postpaid lines to actual loan is a matter of conjecture, which will happen as per the customer expectation over the next quarter. It should broadly be in the same range, but I can't comment actually will be 2 million or 1.5 million or 2.5 million, but it will be in that range for sure.
Sure. And secondly, with respect to the direct cost on the promotional cashback and incentives, so whatever would be the incremental which is there for the quarter, maybe almost like more than 30% kind of sequential rise out there. Any color that you can share in terms of how much would be related to the payments and how much would be towards the rolling out of the financial services, or maybe enrolling more of the customers for that service, and how much would be towards the commerce?
Yeah. So actually the cashback is split predominantly into two parts, which is that we do cashback on our payment services. There is some customer incentives that we also used to pass till September for promoting postpaid at different online merchants on behalf of lenders. So that cashback increased because postpaid as a GMV was very high in the last quarter. That cashback saw a rise. But what we figured out very clearly now with our partners is that is actually a payment charge. So from next quarter onward, that will start showing in a payment charges. So that postpaid incentive will all move to payment charges. So it is predominantly the increase that you see in the last quarter is driven by postpaid.
It's driven by postpaid, yeah.
Postpaid.
Kunal, one more thing I'd like to add here. This is your question was split it in, let's say, payments, commerce, and financial services. So postpaid, because we are accounting for as a payment, so it'll go towards payment charge from next quarter. So you would see payment charge line item. But the commerce part, incidentally, we internally have a key KPI that it should not be more cashback than the margin. We've talked about in our previous earnings also, where our commerce business continues to operate with profitability as a target, and it has achieved profitability, complete operating, full cost loaded profitability. And like you said, we don't have it immediately ad hocly available that this much was for payment, this much was for commerce. In payment, the cashbacks are given only as an incentive to the new customer. If you are a first-time customer, we give you incentive to try out different services. But if you are an old customer, that is reduced dramatically, and that is how the cashback and marketing spends were reduced over the period.
Sure. And lastly, in terms of the commerce, now that maybe with the opening up of all the activity levels and situation stabilizing, and now we would get more sense in terms of how the overall positioning is, say for PayTM in the commerce. So sequentially, I think there was a dip, but otherwise, how should we actually see the traction with respect to the commerce business going forward?
More or less, all commerce, we do three kind of commerce. One is led by shopkeepers commerce, deal, gift vouchers that shopkeepers enable. Second is ticketing commerce, which is led by movie, train, cinema, and all these commerce. The movie part has not come back, by the way. We want to still tell you that movies footfalls have not happened yet. So one of the important driver of the commerce movies has not happened. Third is advertising, which is definitely not just because we treat credit card as advertising. So for us, it definitely has grown. And like I said, first part where we help the shopkeepers has grown, and travel has grown, but not movies.
Yeah. Thanks, and all the best. Yeah, thank you.
Thank you.
Thanks, Kunal. The next question will be from Manish Shukla from Axis Capital. Manish.
Yeah, good evening. Thank you for the opportunity. Firstly, what does it take for a merchant to start accepting BNPL? Because that number is growing very fast at 15 million merchants. So what does a merchant need to do to start accepting BNPL?
So Manish, the merchant has something called a PayTM for Business app. On the PayTM for Business app, the merchant can subscribe to this service. Depending upon the category of the merchant, there is a charge the merchant has to accept. And it could also be given free if you are a very, very small merchant and we would like to enable that merchant for PayTM Postpaid. The moment the merchant accepts the terms and conditions of PayTM for Business app, the merchant is onboarded. If the merchant meets the risk criteria as defined by a risk team, because it's a credit instrument where the merchant is allowed to go through a risk criteria. So that is how the entire onboarding process works. It's completely digital and it is obviously DIY for the merchant.
So the number of devices, we are at 5 million and acceptance of BNPL is at 15 million. Should we think of that 15 million as a potential universe where you can cross-sell devices?
Yeah, I think that could be one of the ways, because these are materially decent sized merchants. Then only they meet the risk filter, and also they meet the classification for themselves to accept a credit instrument. Yeah, so you could say that could be an opportunity, but not an exact opportunity. But yeah, that could be an opportunity for us.
Okay. Moving on to platform fees, could you tell us how does a platform fee work and what percentage of your users might be paying platform fee at the moment?
See, platform fee as a part of our overall revenue is a small number. For our various categories, when customer come on the PayTM app, right, for doing certain set of transactions and activities, let's say movie ticket booking or doing some recharges, etc., there is a small fee which is levied on a cohort of customers because we offer them various other value-added services, including and not limited to things like bill reminders, auto pay, etc., etc. And hence these customers subscribe to these services and they end up paying a platform fee. But purely from a rupee quantum of this charge, that charge is still very immaterial to the overall revenue that we make from payments.
And has there been any communication or otherwise from either the regulator or government about this platform fees being levied? Because in some sense, technically that makes UPI as not a free service, right?
No, so I just want to clarify, Manish. There are two different parts. There is no platform fee that we're charging to merchants when we're giving them any kind of funding source. Some of the competitors do that in the online space. We are not charging those kind of fees, etc. This is the fees that the consumer is paying when they're trying to consume certain services on the Paytm platform. The regulator has very clearly called out on what services you can charge and on what services you cannot charge. The ones they've allowed us to charge, we are charging on them. So it's completely compliant to the regulatory guidelines.
Okay, thanks. And the next question, in response to an earlier question, you said that the starting next quarter, the accounting will move from cashback to processing charges. Is it material enough for it to lead to a sequential decline in net payment margins?
Madhu, would you want to take that?
Yeah, it is a material number, but our net payment margin sort of continues to grow. So it will have some impact, but we don't think it will lead to a drop in net payment margin per se.
Okay. And really the last question, any update on your payment aggregator application with the Reserve Bank?
Yeah, so the payment aggregation, which is our Paytm Payment Services license, is in progress. Whatever engagement that we had to do with RBI has happened. As you can see publicly, that various other PAs have started to get the license. We do believe that we should also be getting our own license in the due course of time and fairly soon.
Okay, sure. Those were my questions. Thank you.
Thanks, Manish. The next question we'll take from Rahul Bangaria from Lucky Investments.
Yeah, thank you for taking my question, sir. Congratulations on a great set of numbers. Just one question: what should we expect the capex rate to be in, on a run rate basis? I see H2 last year and H1 this year were reasonably higher than what we used to see before.
Yeah, so Rahul, most of our capex is related to soundbox and devices, and as you know, we have we have ramped that up, and we have continued to talk about there being a large opportunity there. So currently, I think we're doing somewhere between 120 to 150 crores a quarter of overall capex. As I said, vast majority of that is related to devices, and you should expect that to be broadly the level over the next few quarters.
So roughly, what 400 to 500 crores per annum is the capex that we should expect?
Yeah, I said 120 to 150 a quarter.
Yeah. Okay.
500 to 600 crores a year.
Yeah, and the related question would be, what would be the depreciation policy here? Because now we are running a run rate of about 400 crores of depreciation per annum, and we are doing a capex of 500 crores or maybe 600 crores. What's the policy that we are looking at here?
Yeah, the philosophy that we took on depreciation is that we wanted our depreciation to be, so we wanted the depreciation rate to be faster than the average life of a device. So for Soundbox, we depreciated in 2 years. For a card machine, we depreciate in 3 years, which we think is at least 20 to 30%, if not more, less than the average life of the device. And the way we price this is a payback period, which is better than the depreciation period for the device. So we try to be conservative on each one of these things. But to answer your direct question, Soundbox is at 2 years and card machines is for 3 years.
Great, Madhu. Thank you so much. Thank you.
Thanks, Rahul.
The next question we'll take from Mr. Sameer Bise from JM Financial.
Yeah, hi. Thanks for the opportunity. Can you talk a bit about the GMV per MTU metric? I think last couple of quarters, probably we have not alluded, but how do you think about it over the medium to long term?
Just to be clear, the reason why we don't refer to that number is because effectively, we have a total GMV number, which is all transactions which are processed by PayTM. And in some of those cases, that is being done by the MTU numbers that you see. But in some cases, that is actually not being done by that MTU number. So for example, if I have a card machine at a retail shop or at a petrol pump, they might be accepting credit card, which does not belong to our MTU. And same thing would happen in the online world. Same thing would happen when somebody uses a third-party app to scan a PayTM QR. So there's a fair amount of GMV in our business which is unrelated to the MTU base that you see. So sort of taking the GMV divided by MTU is probably not sort of like the apples and oranges. And as a result, we sort of don't calculate that and get that number because it may be misleading to think that it is this MTU which is generating that GMV. Does that make sense to me?
Yeah, probably I'll take it offline as well. Secondly, there's a news article on RBI giving some clarifications or response on the IT audit. It would be helpful if you could give us some sense on that.
So we actually have in our earnings release given a statement on this. So I've just referred you to that. In summary, the PayTM Payment Bank Management has told us that they have received the IT audited report and RBI's observation on the report. As per the preliminary assessment done by them, most of the observations are around continued strengthening of IT processes, IT outsourcing processes, and operational risk management. And the bank is in the process of responding to RBI. And they're just obviously very, very highly focused and prioritizing the conversation with RBI to make sure that they're fully compliant and that are in spirit. So that's sort of the update that we have. And obviously, if we have more updates, we'll share them with the stock exchanges. But I'll just refer you to the note that we have in the earnings release, which sort of gives you the complete picture.
Sure. Those were my two questions. Thank you and all the best. Congrats on
the opportunity to also mention that we had shared in March 22 when this issue first came up that we believe that the measures that were imposed by RBI on PPBL will not impact PayTM's business, overall business. And the fact that you see the MTU performance and the revenue growth performance of PayTM since then, it sort of confirms that our initial assessment was correct. And we don't see any sort of material impact on PayTM's overall business because of the RBI measure on PayTM Payments Bank.
Sure. That's helpful. All the best. Thank you.
Next in queue would be Rahul Jain from Dolat Capital.
Yeah, hi. Thanks for the opportunity and congratulations on very strong execution. I would just like you to help me on arriving at potential areas for us to get EBITDA neutral and beyond. So firstly, from a payment processing charges perspective, this is the first quarter where we see very little optimization in this line item as a percentage of payment services. So can we conclude that easy optimizations or relatively easy picking in this cost item are behind us, and it would be the run rate that we see right now would be optimized further on a very smaller level? That is question number one. Second, in this quarter, we saw other marketing expenses seeing a big drop. So is that a drop already baked in from a run rate point of view, or some of the savings have come in the second half of the quarter, so we would see this cost going down further in the upcoming quarter? And maybe in general, if you could share what would be the areas where we could see this savings coming incrementally.
Yeah, on your first question, maybe I'll answer it at the contribution margin level, Rahul. We do continue to obviously look for small and big opportunities to improve the profitability of each of our businesses. So we continue to do that. But I think it's fair to say that we sort of went from single-digit contribution margin 2 years ago to 24% a year ago to 44% now. So clearly that sort of trajectory, which was what we call the step change in contribution profit, we don't expect that anywhere close to that sort of pace to continue. But we do and will continue to look for opportunities to do certainly small improvements, if not big improvements, in each of our businesses. We do also expect to continue to benefit from some mix effect, particularly from lending business, because lending is growing and is expected to continue to grow faster than our overall business, and lending is higher margin than our payments business, for example. So we do expect some mix effect, a positive mix effect to come from that as well. On your second question on marketing, like we had mentioned in the last quarter, we did have a jump in marketing costs last quarter because of cricket sponsorships, because we had IPL as well as cricket matches last quarter. This quarter, we did not have that. And as a result, our marketing costs went down. A chunk of marketing costs, not all, but a chunk of it is sort of lumpy, right? Especially when you start getting into sponsorships and so on. So we did not have that this quarter, and we expect that to be at a lower level going forward. Having said that, I will say that if there are opportunities for us to invest in user growth, whether it is through promotion incentive or marketing, which is having good ROI, we'll continue to do that. That will not take us away from our path to break even and our path to creating a long-term, very profitable business. So we'll absolutely achieve that. But if there are opportunities for us to invest in efficient marketing, whether it is through cashback or through ATL or through any other mechanism, we would continue to do that and still achieve our profitability targets.
Right. So just to conclude from your thought, can we say that here on the growth would be more sale optimization and profitability will be more revenue driven rather than cost optimization driven?
I think it's fair to say that revenue growth as well as growth of high margin revenues such as lending will be sort of next big uplift to contribution profit. But I will point out that we have a large payments business which is generating significant net payment margin. So even small improvements in that, when they drop to the bottom line, they can be very significant from a bottom line standpoint, right? So if we are doing 443 crores a quarter of net payment margin, then even a 10-15% improvement in that can have a significant impact on the bottom line, right? So just because the number is actually now quite large, and working on continuing to improve that number is very, very high ROI for us.
Sure. Thank you. Those were my questions.
Thank you.
The next in queue is Mr. Piran Engineer from CLSA.
Hi, thanks for taking my question. Congrats on the quarter. Just on your lending business, firstly on BNPL, if I'm a customer who's paying some fee, and I think 1/3 of the customers who are Delight customers don't pay any fee, how long does it take for me to get upgraded to a Delight customer status, assuming that I don't default, of course?
Hi, Piran. Piran, there is no time-led formula. I think the different lenders have different appetite, but I could say between 6 to 9 months of vintage of performance, continuous performance, the lenders revisit both the limit and the risk classification. And there could be a set of customers who could be upgraded or downgraded. So it is not that once you're a Delight customer, you'll remain always the Delight customers. There is a small portion, I would say, which is downgrade also, and you could also be upgraded. So it is a continuous process, but that ratio or the share of Delight to Light to Mini broadly remains range bound.
But but that's also probably because you're still growing and a lot of your incremental customers will be, say, Light and Mini. I just assume as customers mature over time, maybe next 2 years or 4 years, and of course, if they are paying, you should have more Delight customers than Light and Mini customers. If that happens and the take rates reduce, will you pass it on to the banking partner or will we have to absorb it?
So, Piran, it's a matter of conjecture, which is fairly long ahead of our time at this point in time. I do believe that 2 things will happen, and I think I had mentioned this earlier. Number one, we don't see for at least a couple of years to come, because just 4% of our MTU and MTU is also growing, that a new customer acquisition engine is going to slow down. And I just mentioned in a previous answer that we are seeing very robust growth every month now, more than 400,000, 450,000 users getting added to postpaid. So we don't see that slowing down. And hence the overall share of Delight, Light, etc. will remain broadly range bound. The other thing that we also will see over a period of time is that the merchant looking at the impact of PayTM postpaid to his sale, and hence the increasing the MDR will also be a revenue generating opportunity, which will very easily offset any drop in conveniency if at all it was to happen. So that's the way the entire business model is going to play out. At this point in time, the business model, at least for the next 12 to 18 months, I don't see any change in the business model, albeit it may only have an increase in revenue, especially coming from MDR, because more and more merchant acceptance, especially enterprise merchants, resulting in higher MDRs is the trend that we already see.
Okay, that makes sense. And on your merchant loans, what would be sort of the TAM of this business? I understand it's just like what about 1 or 2% of the merchants have a loan right now. But practically speaking, what percentage of merchants, could be onboarded on merchant loans at just 1.5 lakh ticket size?
Sure. I think that's a very good question, Karan. The simple answer, the way we look at this piece here is merchant loan is a derivative of devices merchant, because largely 80% of our loans are given or taken by a devices merchant. So we index our entire merchant loan business to devices merchant. Today, the number is approximately at 4.8 million, growing about 1 million a quarter. And what our belief here is, once a merchant has taken a device, 6 months forward, their probability of getting eligible becomes very, very high. And give or take, we see about 50% of them keep getting eligible 6 months forward. So as we continue to remain very bullish on adding more and more devices, we obviously remain very, very bullish in adding more and more merchant loan. Having said that, at current point in time, we have approximately 1.5 million merchants who are whitelisted to be given credit and have a pre-qualified offer on the app from various lenders, broadly amounting to about $2 billion of disbursements that we can do. So the TAM of current itself is very large, and as we're adding more devices, the TAM will keep increasing.
Okay, so you said $2 billion.
Yeah, about 1.5 million, 15 lakh merchants are currently pre-qualified by lenders. Approximately, as you know, that number is about 1.5 lakh rupees per merchant. So that's the amount, about 15 to 20,000 crores of value.
Okay, got it. And just lastly, in your earnings release, you mentioned about some seasonality in the cloud business. So you can just sort of clarify what that was.
We mentioned seasonality in our commerce business, and typically Q2 for entertainment is seasonally weak. In fact, we have said specifically for entertainment business, there's seasonality. So entertainment in Q2 is generally weak because of monsoons and so on. Also, this particular quarter, not a regular season situation, but this particular quarter, the content lineup was very weak. And whichever sort of relatively good content that we had in movies also just didn't work as well as it was expected to. So as a result, both movies and events had a seasonally weak quarter.
No, so Madhur, I get that. That was on commerce. But if you refer to your write-up only, I don't know which page, there's no page number here, but I think page 12 of the PDF, you say it's a seasonally strong quarter for PAI Cloud. And clearly it seems so, because last 3 quarters, your revenue was in the range of 190 to 220 crores, and now it's shot up to 250.
Yeah, I apologize. I shouldn't have said seasonally strong. It just was a strong quarter because cards did well, advertising did a little bit better, PI Cloud did well. So I think there we didn't mean to say it was seasonally strong. It was just a strong quarter. Actually, we have not said seasonally strong. We just said it is driven by strong uptake in our credit card distribution. Yes, you're right. And a seasonally strong quarter for PI Cloud. It has nothing to do with season. It just happened to be a strong quarter.
Okay, fine. That clarifies it. Thank you, and all the best.
Thank you.
Thanks. Next question we'll take from Ms. Anand Bhavdani from White Oak. Anand, you.
Thank you for the opportunity, and congratulations for a good ramp up in the lending services business. If you could give us some color on other financial services that you'd want to explore as the lending business kind of continues to gain momentum and it's stabilized, what other financial services are on your priority list?
Anand, we do a PayTM Money, which is a stock brokerage and mutual fund distribution. And we also have insurance distribution and brokerage business. So these two are the other line items.
So on those, can you give us some color as to what you're targeting in terms of numbers and what kind of
They're
TAM?
we call them future bets because there's a tremendous amount of technology development and brewing up that it requires. So they're all materially large. As you can see, the numbers yourself, it is led by credit. Most of the revenue is driven by credit and growth.
Got it. Secondly, on our expected credit loss, in case of merchants, I see the number is higher than in case of postpaid. So just wondering, I would have assumed that merchants, because they are a lot more located on a particular spot, and because they probably have a device and everything, they would probably be lesser credit risk.
Anand, when a loan is defined as a portfolio in lender side, as a part of that definition of loan portfolio, they put expected credit loss as a number. It has nothing to do with expected actual credit loss. That credit loss is called net credit loss, meaning this is when you start a business, you say, this is my customer acquisition cost, this is my credit loss, this is my revenue. So expected credit loss is a number that lender puts in definition of their book of this kind of loss, which is actually nothing to do with whether the loan performance will be based on that or not. What you're seeking is net credit loss, which is in the presentation, and otherwise we always share as a detail in subsequent slides.
And Anand, if I can just supplement to Vijay's piece, there are two different products. BNPL is a 4,500, 5,000 rupees short-term consumption credit for 30 days. The chance of default is far, far lower for anybody defaulting for 5,000 rupees. Whereas the merchant loan is a 1 year, 14-month, 1.5 lakh rupee product through daily installments deducted through pay settlements. So the IRR and the income that the lender makes are very different, and what customer pays in postpaid is hardly much lesser than what they pay in merchant. So from a risk-adjusted return, merchant loan, even at a 5% expected credit loss, while the actual credit loss that Vijay said is lower than that, but expected credit loss, the return for lender and return for PayTM is much higher versus a PayTM postpaid.
Noted. Thank you very much. All the best.
Thank you.
Thank you, Anand. The next question will be a repeat question from Mr. Vidit Jain. Vijay, your line can be unmuted.
Yeah, thanks, Anuj. Just a housekeeping question alluding to one of the comments earlier made. So when a customer scans PayTM QR code to make UPI payment from a competitor app, in this instance, in this particular transaction, there is no scope for monetization, right? And is this particular transaction included in PayTM's UPI GMV when the regulator NPCI reports it on their website?
So Vidit, there are monetization definitely is included. So if you're looking at monetization from a device subscription perspective or from lending perspective, that monetization agnostic to which app is being opened to pay to the merchant, right?
Right.
So you could be scanning from a competition app and paying to a merchant. The merchant still needs a subscription service because he needs reconciliation at the shop, and obviously that GMV that merchant is actually collecting is being processed through us, and that is available to us to underwrite through our lending partners to give credit. So absolutely no problem. And this GMV is called out as P2M GMV also in definition of NPCI, and hence is eligible for various kind of incentives below 2,000 rupees at different points in time.
Okay, got it. Thanks, Bhavesh. That was my question.
Thank you, Vijay.
Thank you. And with that, we come to an end of the Q&A session. As mentioned earlier, a recording of this call and the presentation and a transcript will be put online on the company website soon. Thank you all for joining.
Thank you. Namaskar.
Thank you, everyone.
Thank you, everyone. Good day.